Hey, welcome back. In today's video, we are going to be talking about what is going on in the housing market. We're going to talk about mortgage rates, and we are going to be talking about the 40-year mortgage that's making all the major headlines right now. So let's go ahead and jump right into it. We have new listings are down about 25% year on year. Seasonally speaking, this is really low. And you can see that in prior years going into the summer months is when we generally peak, somewhere around June and July. And as of right now in the beginning of April, we're actually seeing the number of listings come down, and it's pretty hard for home buyers to potentially go out and purchase a home if a seller is not willing to list their property for sale. Mortgage rates continue to stay elevated. The average mortgage payment on the median priced home is sitting just over $2,500 per month. This is up about 11.3% year on year, and it's up dramatically from where we were just a few short years ago. So affordability continues to be an issue facing home buyers in this housing market. We have the 10-year Treasury yield. It remains volatile, and it has for the last month. This is a 30-day chart, and you can see these big peaks and big valleys here. We're currently sitting at 3.52%, and that is up pretty dramatically over the last couple of days with a low at 3.3. That's putting the average 30-year fixed mortgage rate today coming in at 6.39%. So it's up slightly from where we were just a week ago, but it does seem to be kind of hovering in and around this range. So upper 5s to low 6% range for a 30-year fixed conventional mortgage. Now let's go ahead and talk about the 40-year fixed mortgage that everybody on the internet and around YouTube is talking about, because there is definitely some misconceptions about this product and what it exactly means. The Federal Housing Administration, that's FHA, it says that they add a 40-year mortgage. But I want to make sure that everybody understands this is not a mortgage for originations on a purchase or refi. This is what we would call a modification or a loan mod, and it is designed for struggling borrowers. And in other words, it is designed to assist borrowers who are behind on their mortgage payments. Now, for those of you who are not aware, a loan modification is something you generally do with your mortgage servicer, and you have to be behind or delinquent on the property, generally maybe 30 to 60 to 90 days behind before they'll even talk to you about modifying the terms of your existing mortgage. You got to work with your mortgage servicer, and they typically require you to fill out a budget. And now the misconception here is that, oh, we don't need income to do this, or we've lost our income. There are these circumstances where they will look at a modification, but you still need an income because they need to be able to document that you have the ability to repay. And then when they provide you with a modification, it's based on your current income level. So let's say hypothetically, an example would be a borrower who lost their job making $100,000 a year. They took about a month or two off. They found a new job making $60,000 a year. That was a massive reduction in income. It provided financial hardship to them. They can build their case around this particular modification. Now, when the mortgage servicer is working with you and you create this budget, they're going to base that modification off of your new income. There's typically a couple things they can do. They can either reduce the interest rate and keep you on the exact same term, but if you still don't qualify as far as income is concerned, then in addition to reducing the interest rate, they can extend the term up to 40 years to further reduce that payment and put you in a position where now you can afford to stay in that home. And the thing that you have to understand with FHA right now is that these are typically lower down payment loans that are designed for first-time home buyers. So 3.5% down will get you into a property. And over the last year or two, we've actually seen the delinquency rates creep up pretty dramatically on these mortgage products. So the fact that this is rolling out is probably because there is a need for it to come out to be able to keep borrowers in their home rather than going through foreclosure processes. As I mentioned, the FHA 40-year fixed mortgage is actually a modification. It's not something that a mortgage broker can go out and originate and help you get into a home with 3.5% down. But with that said, there are non-QM products that do offer a 40-year loan. They typically don't make a whole lot of sense. Let me explain why. I'm going to compare a 30-year fixed mortgage here to what a 40-year fixed mortgage would look like, and I'm going to explain some of the nuances and the details. So let's just say hypothetically you had a loan of $300,000 at 6.7% at a 30-year fixed. That would give you a monthly principal and interest payment of $1,935. Now, if it's a non-QM product, odds are the interest rate will be a little bit higher, but for purposes of discussion, let's just roll with this. So $1,935, keep that number in your mind for just a second. We go over to a 40-year fixed with the same terms. You'd be paying $1,799 per month, which is about $136 different So to go out another 10 years on your loan, you'd only be saving $136 a month. But one thing that I do want to point out is, generally speaking, when you go to a 40-year loan, you're not going to get the same rates and pricing as you would on a 30. So I just did this to give them the benefit of the doubt. I kept the rates exactly the same to compare the two, but this rate would probably be at least a quarter or 3/8 higher, making the savings even less than the $136 that I mentioned. When you compare the two, here's what I really want to point out. And granted, a lot of people don't stay in their loan forever. You know, they may hold a mortgage for 5 to 7 to 8 years, something like that, before they refinance and or sell. But this will give you an idea of the total interest that you pay and what it means over the life of the loan. If you look at a 30-year fixed mortgage here, so 360 payments, you'd pay a total amount of interest of about $397,000, whereas in that 40-year, just to save the $130 a month, you'd pay $563,000. So it's about nearly $170,000 difference in interest over the life of the loan, which is a dramatic difference for that monthly savings. Though the one thing that I will say is that if this is your only option, it's how you qualify, it'll get you into the home. It's another product. It is an option. Now that they're doing the 40-year fixed loan modification with the FHA, who knows? Maybe eventually they'll roll out a product where they will allow you to originate or purchase a home with 3.5% down using an FHA loan, taking a 40-year amortization schedule. So anyway, that is going to wrap it up today. I hope that provided some guidance and some insight on the housing market and the 40-year fixed loan. We'll see you on the next video. Oh, and if you wouldn't mind hitting that like button, I would be so grateful. And please consider subscribing for more housing market content. Thank you so much. Take care.